Have you ever wondered how a seemingly invincible financial system could collapse overnight? Our world is woven together by intricate networks of financial systems, the lifeblood of economies. Their strength and stability are paramount, yet they carry an inherent fragility. A single misstep, a moment of unchecked speculation or overconfidence can send shockwaves through these financial webs. Now let's journey back to the Roaring Twenties, a time of prosperity that veiled an impending disaster. Let's delve into the story of one of the most significant financial crashes in history. The 1920s, often referred to as the Roaring Twenties, were a time of prosperity and economic growth. This was an era marked by unprecedented consumerism, driven by innovations in manufacturing, advertising, and easy access to credit. Americans were buying everything from automobiles to toasters on installment plans, fueling a consumer boom that seemed unstoppable. And then there was Wall Street, the beating heart of America's burgeoning economy. The stock market was riding high on a wave of optimism and speculation. Everyday folks and seasoned investors alike were caught up in the frenzy, buying stocks on margin with borrowed money, betting on the promise of ever-rising share prices. The economy appeared to be on an upward trajectory with no end in sight. Confidence was high, the mood euphoric. It seemed as though the good times would roll on forever. But, as we know, nothing lasts forever. But this era of economic prosperity was about to come crashing down. The stock market bubble was fueled by a dangerous mix of speculation, easy credit, and overconfidence. Let's delve into these factors a bit more. First, speculation. The Roaring Twenties was a time of rampant speculation. Investors, both big and small, were buying stocks on margin, which essentially means borrowing to invest. The promise of quick and easy profits lured many into this risky game. They believed that the market could only go up, and this blind faith fueled a speculative frenzy. Second, easy credit. The Federal Reserve, the central banking system of the United States, kept interest rates low during the 20s. This policy made borrowing cheap, encouraging more people to take out loans to invest in the stock market. The easy availability of credit inflated the stock market bubble even further. Third, overconfidence. The economic prosperity of the 20s bred a sense of invincibility. The belief that the boom times would never end permeated throughout society. Banks, investors, and the general public were all swept up in this wave of optimism. This overconfidence made people overlook the warning signs. In the lead-up to the crash, there were indeed warning signs. Economists and financial experts started to voice concerns about the unsustainable stock market boom. The market was becoming increasingly detached from the underlying economy. Some stocks were being traded at prices far beyond their real value. Yet, these warnings were largely ignored. In the summer of 1929, the market started to show signs of instability. Prices fluctuated wildly, and trading volumes soared. Still, the majority remained blissfully unaware of the impending disaster. They continued to buy stocks, further inflating the bubble. The culmination of speculation, easy credit, and overconfidence, along with the dismissal of cautionary signs, created a precarious situation. The stock market was like a house of cards, teetering on the brink of collapse. The bubble continued to grow until it could no longer sustain itself. All these factors set the stage for the impending crash. The stage was set, and it was only a matter of time before the bubble would burst, triggering the most devastating stock market crash in history. The critical days from October 24th to October 29th, 1929, saw the stock market in free fall. This period, forever etched in history, begins with Black Thursday, October 24th. The Wall Street ticker tape couldn't keep up with the deluge of sales, and by noon, a record 12 million shares had changed hands. Panic was the order of the day, and it was palpable. In a bid to stabilize a market teetering on the brink, leading Wall Street bankers convened at the office of J.P. Morgan and Company. They hatched a plan to buy up significant blocks of stock, attempting to inject confidence back into the market. Their efforts, though heroic, were akin to trying to hold back the ocean with a broom. The market closed on Black Thursday with the Dow Jones Industrial Average down 33 points, a drop of about 9%. The following day, Black Friday, saw a brief respite. But the weekend did nothing to quell the growing unease. Investors were spooked, and the market's fragility was laid bare for all to see. Then came Black Monday, October 28th. The market plunged at the opening bell. The bankers' attempts to support the market had proven futile, and the selling frenzy resumed with renewed vigor. The Dow Jones Industrial Average fell nearly 13%. The climax of this downward spiral arrived on Black Tuesday, October 29th. Over 16 million shares were traded in a single day, a record that stood for nearly 40 years. Investors scrambled to unload their stocks at any price. Even blue-chip stocks weren't spared, their values decimated. The Dow Jones Industrial Average fell another 12%, culminating in a two-day loss of nearly 25%. The Wall Street was left in ruins, marking the beginning of a severe economic downturn. The events of these 5 days, from Black Thursday to Black Tuesday, remain a stark reminder of the devastating speed at which financial markets can unravel, forever altering the course of history. The immediate aftermath of the crash was catastrophic. Wall Street was in a state of chaos, with investors scrambling to cut their losses. Confidence in the American financial system crumbled overnight, leading to a mass exodus of investors from the stock market. The once vibrant and bustling Wall Street was now a ghost town, its silence punctuated only by the occasional sobs of ruined investors. The banking sector, too, was not immune to the crash. Banks that had heavily invested in the stock market or that had loaned money to stock investors were suddenly confronted with mountains of bad debt. In a desperate attempt to recuperate, they called in loans and sold assets, but this only exacerbated the crisis. A banking panic ensued, with a multitude of banks closing their doors, unable to fulfill the withdrawal requests of their panicked customers. The general public bore the brunt of the crash. Millions of Americans who had invested their life savings in the stock market were left penniless. Unemployment skyrocketed, as businesses, unable to secure loans for operations or expansion, were forced to lay off workers or shut down entirely. The American dream seemed to have turned into a nightmare overnight. The crash didn't just signify the end of the Roaring '20s, it marked the onset of the worst economic downturn in history, the Great Depression. The ripple effects of the crash extended far beyond Wall Street, permeating every aspect of American life. The economic prosperity of the 1920s was replaced by a decade of poverty, unemployment, and economic stagnation. The rest of the world was not spared from this economic calamity either. America's economic woes rippled across the globe, leading to a worldwide economic depression. Countries dependent on American investment or trade were particularly hard hit. The global financial system, so intricately interconnected, felt the tremors of the Wall Street crash. The crash had far-reaching effects, impacting economies worldwide. The Wall Street crash of 1929 became a stark reminder of the fragility of financial systems, the consequences of unchecked speculation, and the importance of regulatory oversight. It marked the end of an era, and the beginning of a decade-long struggle for economic recovery. The crash led to significant changes in the regulatory landscape. Stunned by the scale of financial devastation, the government scrambled to respond. Initial reactions were a mixed bag of measures, from bank holidays to attempts at reassuring the public. However, it soon became clear that a more structured approach was needed. Enter the Securities and Exchange Commission, or SEC, established in 1934. Its prime directive was to restore investor confidence by providing transparency to the markets. This was a game-changer, introducing a level of oversight and regulation that was previously non-existent. But the ripples of the crash extended beyond Wall Street. The Great Depression that followed reshaped American society and the global financial system. Unemployment soared, and breadlines became a common sight. The economic hardship also sparked significant migration within the United States, as people moved in search of better opportunities. Internationally, the Depression altered the balance of global power, leading to a shift away from the gold standard and paving the way for the United States to become a dominant economic force. The long-term consequences of the Wall Street crash of 1929 still echo in the corridors of financial power. It is a stark reminder that unchecked speculation, lack of transparency, and overconfidence can lead to disaster. This crash was a painful lesson in the importance of regulatory oversight. The Wall Street crash of 1929 holds invaluable lessons for today's financial markets. The crash underscored the inherent risks of speculation, overconfidence, and lack of regulatory oversight. These factors created a volatile environment, primed for a market collapse. Today, we're not immune to these risks. Indeed, the global financial crisis of 2008 echoes the lessons from 1929. Unchecked speculation and poor risk management can lead to devastating consequences. Furthermore, the crash revealed the interconnectedness of global financial systems. A collapse in one part of the world can trigger a domino effect across nations. Our financial markets today are even more tightly interwoven, amplifying this risk. Finally, The aftermath of the crash highlighted the importance of government intervention in stabilizing markets and restoring consumer confidence. The establishment of the Securities and Exchange Commission in the aftermath is testament to this. Understanding financial history is crucial to preventing future crises. Reflect on this as we navigate through our complex financial world.